Hello everyone and welcome. My name is Elliot Gu. I'm Chief Analyst for the Deep Dive Investing Service. And this video is actually a follow-up video to one you should have received a couple of days ago in your inbox where I talked about different kinds of orders that you can leave with your broker. You know, for example, limit orders to buy a stock or sell a stock, stop loss orders, what's the difference between day orders versus good till canceled orders, some of the basics of the technical aspects of trading, if you will. Today I want to take that and show you why that's important for the strategies we employ in the Deep Dive Investing Service, for how we think that it's best to scale in and scale out of our recommendations. And I'm going to show you some very specific examples of actual stocks that we've recommended over the last 18 months or so, which I gleaned out of this book where I keep track of some of the ideas that we've published and some of the recommendations we've made, the when and why we recommended them at those times. So I want to start out here with this basic agenda. I'm going to go through some slides here as we talk. And first up here, I'm going to take a look at the investment process we employ. And it's not just in deep dive investing, it's across all of our services. And I think that if you employ some of these techniques in your own investing, you'll find that it actually adds to your returns over time and generates alpha for you. Second thing I want to talk about is why technical analysis, and that's looking at charts, looking at indicators, for example. It's often thought of as just for traders. That's absolutely untrue. Even long-term investors can benefit from a look at some very basic technical indicators on the charts. I'm going to show you one of them today. I'm also going to talk about a strategy that we employ in Deep Dive, as well as across our investing services, called our Dream Buy strategy. You may have heard of this before from either me or my colleague Roger Conrad. It's something we do in the Deep Dive service, and I want to tell you how it works and why we use it. Also talk a little bit about how and when to implement stop losses. Stop losses, I think, are probably among the most overused order types in the markets today. They're very useful, but they are not the be-all and end-all that some people feel that they are. The best way to go through all of this is for us to illustrate these techniques, some of our strategies, and the tactical aspects of trading these stocks that we recommend, is by going through examples of stocks and sectors we've recommended in the past, why we got into those stocks the way we did, and this is from an investment standpoint, not a trading standpoint. And of course, you know, a lot of times in the newsletter industry, people always brag about their successes and they forget about their failures, and that's so disingenuous. I want to tell you a situation where things went wrong for us and how we used our risk discipline and some of these tactics and strategies to kind of minimize the damage, and how frustrating it can be. So first up, I want to talk about one of the first recommendations I ever made in deep dive investing, actually the first recommendation I ever made when we launched the service, and that was back in March of 2017. In this case, I did a long presentation on regional banks back in the March 13th issue, 2017 issue of Deep Dive Investing, and it was a bullish call, a positive call on U.S. regional banks. There were two main pillars, if you will, to my argument. The first was, in late 2016, Donald Trump had been elected President of the United States, and one of his platforms that he talked about on the campaign trail and once being sworn in as president was to begin to deregulate a little bit in the United States, and in particular, roll back some of the regulations put on banks following the financial crisis back in 2007 and 2009, and that Dodd-Frank Financial Reform Act that was put in place in 2010. One of the leading candidates for reform was the asset limit on regional banks. And what do I mean by an asset limit? Well, under the 2010 Dodd-Frank Act, the government set up a process of stress testing, technically called the Comprehensive Capital Analysis and Review. It's an annual procedure that the Federal Reserve goes through, testing banks' ability to handle various economic and credit market scenarios. And every bank with total assets of over $50 billion had to go through that. So the SIFI, the systemically important financial institution, or SIFI rules only went into place for banks that had more than $50 billion in assets. It was a straight up $50 billion, not adjusted for inflation or anything like that. Now, of course, your large banks in the US, like your JP Morgans and your Citigroups, of course, they were definitely going to be considered systemically important financial institutions, or SIFI banks, subject to these extra regulatory steps. But also an awful lot of regional and super regional banks in the US were caught by these SIFI rules, and that was an additional cost for these banks. It also typically meant that the decision to distribute capital to shareholders either via dividends or share buybacks wasn't held in the boardroom of those banks, but actually by the Fed. The Fed could say, no, you didn't pass this aspect of our stress tests enough. We won't allow you to pay out as large a dividend as you want to. One of the things that President Trump and others in the Republican Party had talked about way back in 2016 and certainly in early 2017 was the idea of raising that SIFI designation from $50 billion up to $250 billion. We felt back in March of 2017, and one of the reasons I recommended the regional banks back then, we felt that that would go through. Under a Republican administration, we felt that there would be reform on the SIFI designation. A lot of Democrats also supported some reforms that would allow certain regional and local banks not to be caught by the SIFI designation. We felt that it would go through, and in fact, it did go through earlier this year here in 2018. So that was pillar number one. Pillar number two, rising interest rates. You've probably heard somebody say, some pundit on TV or some article on the internet where they say, banks benefit from rising interest rates. Rising interest rates is good for financial stocks. That can be true, and it can also be untrue. And here's why. It really depends upon what the bank has in terms of loans outstanding. I worked for a bank as a summer internship way back almost 30 years ago now. And one of the things that I was told there was the 363 rule, and it was kind of a joke in the industry. And the idea was the bank would take in money and pay 3% on deposits, turn around and loan that money back out to businesses or consumers at 6%. And if you do that right, you make the profit on the spread between the cost of your deposits and the amount that you're able to earn in interest on loans. You can hit the golf course by 3 o'clock in the afternoon, no problem, easy business. Of course, it's not that easy, but the basic tenet holds. Banks are in the business of taking in deposits, paying a low rate of interest on those deposits, and then lending that money back out to businesses or consumers at a higher rate of interest. But there are many different types of loans, and they have different characteristics. For example, you could have a 30-year fixed mortgage loan where the interest rate is fixed for the term of the loan. In other words, when interest rates go up, when prevailing interest rates go up, the bank doesn't benefit from that because that interest rate is locked in. Multifamily loans, for example, also tend to work that way. Typically for the first 5 or 7 years of a loan to someone who owns an apartment building, the interest rate is fixed. Therefore, they don't directly benefit from rising interest rates. There are some classes of loans, though, that are floating rate loans, that tend to be floating rate loans. The biggest is commercial and industrial loans, that is loans to businesses. They're typically priced off of LIBOR, the London Interbank Offered Rate, the 90-day T-bill, or some other short-term interest rate. So when the Fed hikes interest rates, those loans immediately reprice higher, meaning that the banks benefit from rising interest rates, rising interest charge on those loans. So that was the second element, that we felt interest rates would continue to rise, and therefore that would benefit the banks. And as you can see on this chart here, we were right about interest rates as well. That first arrow you see there is the U.S. presidential this is the yield on 2-year U.S. government bonds. You can see that the first arrow there points to the U.S. presidential election in November 2016. The second arrow there, that blue arrow, points to the date that I published this issue of Deep Dive Investing, which was again March 13th of 2017. And you can see that since that time, interest rates have continued to go higher as we expected, going from under 1% prior to the U.S. presidential election in late 2016 to around 2.6% as of here in the middle of August of 2018. So that was a tailwind for certain banks that have a lot of these floating commercial and industrial loans. One of our top recommendations is this bank, pictured here on this chart, a bank called Comerica. The symbol there is CMA. It's one of the banks we recommended first back in March of 2017. And the reason is that we looked at a total of about 70 banks in the United States. And we looked for banks that had a lot of these floating rate commercial and industrial loans. Comerica is one of the few remaining traditional business banks. Almost all of their loans are floating rate loans, which means they benefit immediately from rising interest rates. That was one of the key tenets for us recommending the bank. The second thing is that Comerica has total assets of around $70 billion. So remember what I said earlier, back in early 2017, the SIFI limit, where you were subject to those additional regulations, was $50 billion. Comerica had over $70 billion in assets. They were a SIFI bank. However, if financial reform did raise the SIFI designation to $250 billion, suddenly Comerica goes from being a bank exposed to extra regulation to being a bank that has less regulation ahead of it. And of course, that would be beneficial to the company, and it was, as the SIFI designation was raised this year. But you can see here, by the time we recommended this bank, it was already up nearly 40%, and I can show you here on this chart. You can see here I've added in a percentage change here. I'll try to circle it for you. Hopefully you can see that well. The bank was up 39.3% from the time of the U.S. presidential election until we even recommended it then in March of 2017. So it was already up a lot. And just look at that chart there. It went almost straight higher from the time of the presidential election all the way up until the end of the year. And then it kind of traded sideways a bit. But by the time we recommended the stock, and I'll point this out to you as well on the slide, but by the time we recommended this stock, it was already up, again, close to 40% from its highs. So it would be logical to expect, perhaps, that this bank would be due for a little bit of profit taking, some backing and filling on the charts before heading higher, as we expected it to. So what we recommended was buying some of the position in the bank, buying a little bit of the bank, a few shares of the stock right away, on the view that it's quite possible, given the strong fundamentals behind Comerica, that it could continue higher in the near term. And that would give you some exposure to more upside in the bank. But we also thought that it would be logical to use any broader market volatility, to use any kind of a pullback in the banks as an opportunity to add to that Comerica position. So rather than putting all your money to work right away at the price it was trading at that day, we recommended buying a little bit and then buying more on a dip in price. And I'll show you here on the next couple of slides exactly what our thoughts were and why we did it this way. First up, though, you often have to look beyond, you'll often hear people say, like I showed you on Comerica on the prior slide there, that this bank is overextended. And it kind of did look overextended on the charts because the stock had gone up so much. But if you look at valuation terms, Comerica was actually cheaper than the industry benchmark KBW Banking Index at the time we recommended it in March of 2017, and that's actually shown on this slide here by that vertical line you can see on the chart there. Comerica was actually cheaper than the KBW Banking Index, despite having much above average exposure to floating rate loans. So we didn't think Comerica was as extended as it looked, and that there would be more upside to the stock if, as we expected, interest rates continued to rise and regulatory reform came through. So again, here's what we did. We bought a little bit of Comerica right away. We recommended buying a little bit of the stock for the deep dive investing portfolio at 72. And then we recommended setting a dream buy price of 65. Now what's a dream buy price? A dream buy price is a valuation level for the stock where we think it's a very compelling value. And typically the way we recommend setting a dream buy price is by logging into your brokerage account and setting a good until canceled buy limit order on that stock at our dream buy price. In this case, that dream buy price was about 65. So it was roughly a 10% pullback from where we first bought the stock in March of 2017. We didn't really expect Comerica to pull back so quickly after we recommended it, but it did. And by the end of March, which is the second arrow here, that good until canceled buy limit order would have been executed for you at a price of $65 a share, and that happened on the 22nd of March. So think about what we did. Rather than putting all our money to work at 72, we bought a little bit at 72. We recommended buying about half your intended position at 72, and we recommended adding to that position on a dip to around 65. Why 65? Well, 65 is a level that had acted as a technical support level on the charts. And you can see it here back in early January, in mid-January of the same year. Comerica had pulled back to about 65 and then bounced. That's a logical area to expect a little bit of consolidation or support on the charts for the stock. And so that's where we set that buy limit order, and it worked like a charm because Comerica then proceeded to rally all the way up to over $100 a share here in 2018. So this has been one of our most successful recommendations to date. And we actually added to our returns, added one of those few extra precious percent to our returns by buying a little bit to start and then scaling into the stock on about a 10% dip. We actually recommended a total of 5 banks in that initial issue of Deep Dive Investing. Over time, we took some banks out of our recommendation list and added new banks to our recommended list. But here's what's happened since that time. As I said, our first recommendations were on March of 2017, and I ran these numbers through mid-August of 2018. Our Deep Dive Financials recommendations, the regional bank recommendations, were up about 25.65%. Over an equivalent holding period, the S&P 500 was only up 11.4%, and the KBW Regional Banking Index was only up 11.9%. If we had just gotten into the banks on the day we first recommended them, without setting those dream buy prices and looking to buy those banks on a dip, our returns would be a little less than 20% for our regional banking picks. So think about that. Just by using this very simple strategy, easy to implement, of buying the stock on a dip using that good until canceled limit order, using that dream buy strategy in short, you added over 5% to your returns from those recommendations since March of 2017. So the recommendations were still good even if you just ran out and bought the stocks, but 5% is a precious additional return from any bet. Here's another example. Dover, symbol DOV, is an industrial company. We recommended this as part of an issue we did in May of 2017, May 24th of 2017. A couple of different rationales behind it. On the sector level, industrials are one sector that's most exposed to economic growth. So when economic growth is picking up, and in particular manufacturing activity is picking up, that tends to be very good news for industrial stocks. We saw the economy continuing to strengthen in the second half of last year and into 2018, and as a result we thought industrials were a great place to be. Secondly, Dover specifically was a company that was expected to execute a spin-off transaction where they were going to take their oil services unit and spin it off as a separate company. Over the years, I've found that spin-off transactions tend to be very profitable for shareholders of the parent company. Oftentimes, companies really do unlock value, at least in the stock market, by selling off or spinning off a division of the company to make that company more logical and simpler. In this case, Dover had a lot of steady Eddie, slow growth businesses that aren't particularly cyclical, and this very, very cyclical energy business. Now the kind of person who wants to buy a fast-growing energy business is very different from the kind of person who wants to buy the other parts of Dover's businesses which were slow growing. So we felt this was a tailor-made situation for selling off that fast-growing, volatile, cyclical energy division and realizing value for shareholders. As you can see from this chart, That spinoff was completed in May of this year. The stock actually ran up a lot, though, over the back half of 2017 and into early 2018. This was a good recommendation for us. We initially got in, as you can see here, in where that first arrow is, back on May 24th, and the stock kind of traded sideways, dipped a little bit, and then started a steady rally. By late September, early October, the stock started to look a little bit overextended. And you can kind of see that here on the chart, hopefully, where at that time, and I'm talking about late September, early October, I'll circle it here for you on the chart, the stock had already run up a lot from where we initially got in, and it was trading above all three of these moving averages. That purple moving average you see there is actually the 50-day moving average. The green line that you see on your chart is the 100-day moving average, and the yellow line there is your 200-day moving average. So one of the ways that we evaluate whether a stock looks extended on the charts, just a quick, simple technical analysis strategy you can use. It's trading a long way above that 50 and 100-day moving average. So it's clearly in an uptrend, but it's just pulled a little bit away from that 50-day moving average, starting to look a little extended on that basis, and you can see it there. So what we did in September was to recommend a dream buy price on Dover down around that 50-day moving average. So we set that dream buy price around where the 50-day moving average was trading, on the view that if it did see a pullback, often stocks in a powerful uptrend like that will find support. The stock will kind of stop falling on a correction around that 50-day moving average. We thought that was a great opportunity. We also felt that you might actually see some volatility around Dover's earnings release in October that would allow us an opportunity to take advantage of that volatility to buy more of the stock at a favorable price. And that's exactly what happened. You can see it there. On the day of its earnings release, the initial reaction was negative in the stock. As the company hosted its conference call, though, and talked rather bullishly about its energy services unit, the stock did rebound literally the same day. It gave us an opportunity, though, using that good until canceled buy limit order, to buy the stock automatically. You could have been out to lunch at that time. You could have been out playing golf at that time. Your broker would have automatically executed you on that opening dip at a very favorable entry point. And that added several percent to our returns in this successful recommendation to the time too early this year. Another strategy that we sometimes use is what's called a stop loss order. I explained that on the prior video. Hopefully you all saw that. But basically, what a stop loss order does is it tells your broker to automatically sell you out of a stock when a certain stop price is touched. So let's say a stock's trading at $100 a share. You set a stop loss at $90 a share. Good until canceled stop order at $90 a share. What that means is the second that that stock trades down to $90 a share, your broker will automatically sell you out. The idea, of course, is that when you don't want your losses to grow too big. So by setting that stop loss there, your broker is automatically going to get you out at about a 10% loss in that little example I just used before it becomes a 20 or 30% loss. Cigna is a stock that didn't work out so well for us. In fact, it's a recommendation we had in Deep Dive Investing. I believe it's our worst recommendation to date in terms of percentage decline. It's down about 13% from where we initially got in to where we got out. And I wanted to show you how sometimes ideas go wrong. Cigna was a stock we recommended in November of 2017. It's a health insurance company, has a very steady business, and we particularly like their business selling insurance policies to very large companies. Very high margin business for them. And we thought the stock was a high quality company, and I'm going to explain that actually on an upcoming video, what we mean by high quality, that would do well at this stage of the business cycle. And initially we looked very right. The stock ran up from where that first arrow points to our initial entry point, under $200 a share. It ran up all the way up to a high of $227.13 in late January. But then it all went wrong. Initially, the stock declined just alongside the broader stock market. We actually recommended adding a little bit more to the stock on that dip in early February because we felt that the stock was selling off solely because of broader market concerns rather than anything specifically fundamental to the company. And then two things happened. First of all, there was an announcement from Amazon and JP Morgan and Berkshire Hathaway that they were going to band together to create a company to help manage their internal health costs for their employees. That was seen as competition for Cigna because that's basically their business. We think that view is totally overblown. That company that Amazon is forming with Berkshire and others is still years away from actually doing anything. So we thought that was overblown. We didn't think that was such a big deal. Then though, in March, Cigna actually announced the acquisition of Express Scripts. This is a company, a pharmacy benefits management company. The market just didn't like this acquisition. The market really wanted Cigna to merge with another health insurance company or purchase another health insurance company to enhance its growth prospects over the next few years. They didn't want them buying a pharmacy benefits management company. And as you can see, the stock sold off sharply here in early March in the wake of that news. Now it sold off all the way down to the low 160s. And we felt that there was a good chance that Cigna would rebound from there. So we were down on the stock, but we felt that there was a good chance that the market had overreacted and would rebound from there, maybe back up to the $190 to $200 area. So here's the way we managed it. Rather than selling out of the stock at such a low price, what we recommended setting a stop loss order around where that blue line there, that horizontal blue line is on the chart on your screen. The idea being, if Cigna did bounce, we would benefit from that. We would be able to sell out at a more advantageous price. We were committed to getting out of the stock, but we could sell out at a little better price than where it was trading in March. However, if the stock just resumed its slide, at least we would be out of the stock before the loss snowballed into something a lot bigger than just 13%. What we did is we set a stop loss there. The stock did bounce a little bit, but then guess what? It pulled back and stopped us out. And then, to make matters worse, it went ahead and finally we got that bounce up to 190 that we've been looking for. I wish I could tell you that this won't happen to you, but it does. I've been doing this a long time and I've seen this happen countless times. It's very frustrating. However, the key is not to have a selective memory. As investors, we often go back and remember when setting a stop cost us money, but we forget all those times where setting a stop saved us a lot of money when the stock continued to go lower. And I try to keep very accurate records, a lot of times in traditional notebooks. I don't know, that's just the way I've been doing it for 20 plus years now. I try to keep accurate notes as to why I set stops, when I set stops, and how it worked out. And usually, the majority of the time, it's a good idea to do it on a situation like this, where you want to get out on a bounce, but you're worried that it might continue going lower. It's easy to fall into that trap of hoping for a rally, but not getting it, and then continuing to justify it, holding the stock as it continues lower. In this case, we did get stopped out for a loss. If we'd set the stop just a smidge lower, we would have been able to get out for a much lower loss by August when the stock bounced back up to 190. But I still think it was a good idea, and that's how we tend to use stop losses. When we're thinking about getting out of a stock that's pulled back, we'll set a stop loss under a key technical support level. And that way, if we think there's going to be a bounce, we can still benefit from that bounce. But if the stock heads lower, we'll get out before that loss turns into a bigger loss. We did actually use a similar strategy in a bank that we recommended earlier this year that allowed us to hold on to that bank because it did bounce as we expected, and it didn't stop us out. And we're still in that recommendation right now. So that's an example of when it did work, an example of when it didn't work. These are just a few of the strategies we use in deep dive investing, scaling into recommendations on dips using a dream buy strategy and good until canceled limit orders, and also kind of the way we use stops. Sometimes we use it as a way of when an investment isn't working out in their favor, when the stock's not reacting as we expected. We often will recommend setting a stop to kind of protect ourselves from falling into that trap of just hoping for a recovery that never comes. So thank you very much. Again, my name is Elliot Gu. In a couple of days, I'm going to send you another one of these videos where I'm going to talk about quality. This is a quantitative measure of profitability, of market profitability, that often works in the latter stages of a bull market. We have 2 recommendations that we've actually recently put into our deep dive investing portfolio that have done phenomenally well based on this quantitative metric. I want to explain that to you, how it works, how we screen for it, and why we think it's going to continue to perform over the next 6 months or so. Thank you very much for listening to me today. Watch your inbox for that next video.